Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Hey there everybody, Steve Waters and Victor Kumar once again back for our fortnightly filmed version of Investing Insights with Right Property Group. Last fortnight we had Brad Beer
that's right,
from BMT to talk everything around depreciation, and I believe he got a million questions because we gave out his
personal email and mobile, didn't we?
I know that, but he asked for it. It wasn't though we just,
he's just a
it on
glutton for punishment. That's what it is.
Yeah, but he's a good guy and very good operator at what he does as well. So Vic, it's been a massive fortnight in terms of the good, the bad, and the ugly. Crisis after crisis, whether it be, well, as of today, we have the border lockdown between Victoria and New South Wales, even though this will be out a few days after that. We have political unrest in certain areas across the world. We have obviously COVID, which is having its second wave of infections in Australia and other parts of the world. It's just beyond control, if you will. And whilst that doesn't sound like a very rosy picture of what's happening in the world at the moment, nonetheless, there's always a crisis. There's always something, always has been, always will be. And I'm not for 1 minute downplaying the severity of what is happening, especially with COVID. My point is there is always something.
That's right. And I guess this is where it sorts out whether you are a problem for every solution type of guy or a solution for every problem type of guy, isn't it?
Can you say that one again?
That's a bit of a tongue twister, isn't it?
It is. It's half glass full, half glass
That's
empty at the same time. And you don't want to be an ambulance chaser and benefit off other people's misfortune. But there is always something that will stop somebody or perhaps even invigorate somebody else.
And in every crisis, there's always a flow of wealth. And the flow of wealth is usually from the ones that are unprepared to the ones that are prepared, and the ones that have educated themselves and are able to see the silver lining in opportunities and see how they can better their position without doing anything untoward, and making sure that they don't get caught up in all the hype, in the negative media, in the negative news that's flowing around. This is reality, and we need to accept it as reality and say, okay, how can I really better my situation or solidify my situation based on the current circumstances, because these are the cards we're dealt.
Absolutely, and I'm glad you actually say that, because today I wanted to talk about the state of your wallet dictates the state of your mind. And what I'm really referring to there is about cash flow or cash flow management and creating an asset vehicle. And in our case, it's property, about being balanced. Because there's the age-old argument is around, should I invest for growth and don't worry about the cash flow, or should I invest for cash flow and put growth as a secondary part of the equation? And what I wanted to talk about today was that you actually need both. You can have both. It's just the way that you go around it.
That's right, yeah. So if you were doing live TV, this would be the time where we'd cut away to a break, isn't it? Because we're about to reveal the whole holy grail.
The secret sauce. Yeah, we'll be right back after this break. I'd actually be interested to know, because I know a few podcasts do have the commercials in it. Not that we will ever do that, but I'd be interested to know if it just ticks people off.
Yeah, do send us an email with your
I'd
thoughts,
love to
right?
know. Because I get annoyed.
Yeah, I do too.
It's just like, just as you got me, you want to throw to a break.
Yeah, but I guess,
it's like the days of our lives.
Yeah, it is. I think that's the way things are forming out at the moment. Yeah, but coming back to cash flow or capital, what do we concentrate on, and what's the better approach? Do we concentrate on just cash flow? Do we concentrate just on capital growth and high growth, or is there a better way?
I believe there's a better way. I know you do as well.
Absolutely.
But before we get into that, one of the other big bits of news was that everybody's been talking about this cliff face that is approaching in September, when the mortgage moratorium ends, JobKeeper, JobSeeker, and the like. And I really have a trouble trying to get my head around all the negative media around that. Now, I know that's clickbaitable and, good news isn't good and doesn't sell, but bad
Yep.
news does. But does everybody just think that the government and the banks are going to flick the switch off and kill the economy, like just overnight, come whatever?
After doing all this hard work.
Yeah. And as I say that, the banks last night have come out and they're going to continue being a shock absorber for the economy.
Mhm. For at
and
least another 4 months.
for at least another 4 months, and extend for those that need it,
Mhm.
the mortgage moratorium, and good on them for doing that. And I'd also suggest that the government, in their role with the JobKeeper, JobSeeker, might have different frameworks around come
That's
the end
right,
of September, as opposed to what it looks like now. But for 1 minute, if the economists and those that are on the negative side of the ledger think that the switch will be just flicked and the world will implode or Australia will implode,
Mm.
it's just not responsible
Yeah, I
reporting.
guess what will happen is the qualification criteria will be a little bit more stringent, because when we started out, it was anyone that applied pretty much almost certainly got the nod to say, okay, you can go on mortgage pause. The same with JobKeeper as well. But now they're going back and doing the audits. And the ones that had fudged their figures to capitalize on misfortune, so to
Yeah.
speak, now they're going to pay the penalty for it, right? And going forward, they'll be a lot more stringent, because we have now had time to put processes in place to mitigate those things. And obviously, with the banks, they will ask more pointed questions. They may ask for employment details and all that sort of stuff before they put you onto a further extension of your mortgage pause. But I need to flag this again, like we did before, that when you are going into mortgage pause, you're actually increasing your debt. So when you come out on the other end, you need to calculate whether you are going to be able to afford the repayments as they kick back in at the higher debt. So effectively, you're adding almost a year of interest repayments, or even full principal and interest repayments. And therefore, the new repayments would be calculated off that new balance, or they may reduce the time on the mortgage or increase the time depending on how the bank looks at it. And that'll definitely impact the monthly repayments that you're going to make.
Yeah, and so think long and hard about it, but if you do need it, you do need it, because
Yep.
it keeps you in the market.
That's right.
Essentially, over this speed hump. Now, the reason I bring that up is because essentially that's all around cash flow.
Mhm.
And the subject today, once again, is around cash flow management and creating a balanced portfolio. So let's address the very first thing here, which is what is the correct way? Is it growth? Should we be just going for all growth, or should we be going for all cash flow? And the answer to that really is different for everybody.
For everyone. Yep.
Yeah. Now, there is no wrong or right decision there. And there are some people out there that say, well, the more expensive the property is, therefore in potentially CBD areas, offer a better rate of growth.
Mhm.
And there are some that say, well, you'll never get the cash flow out of a property unless you go into higher risk areas. And I just don't buy into each of those comments.
That's
at
right,
the end of the day. And I certainly don't believe that you have to spend $1 million for it to be a wise investment decision.
I agree. And I guess the other thing we need to define here is, when we're talking about cash flow, we're talking about cash flow in your budget, in terms of your ability to hold onto the property. We're not necessarily talking about positive cash flow property out in whoop whoop. We're talking about still investments in sound fundamental areas, and which is affordable to your budget. So I guess before you can even decide on whether you're going capital or cash flow, or a blend of both, which is our preferred method, you need to first of all work out where the household budget sits. In other words, after you've lived, how much money is left, or how much money are you putting aside towards holding your investments? And that then determines where you can buy and what type of property in terms of the negative cash flow that it may bring. And then the next thing that you're looking at is obviously how much capital you've got to get started, right? So it could be that you can afford a property with a negative cash flow of, say, $400 a week, and just making these numbers up, $400 a week in negative cash flow before tax. Yet the amount of capital you've got to get started is only $50,000. certainly you'll be going into the lower price bracket because of the amount of capital you've got. So you need to work all of those things out first before you can even answer which way you're going.
Yeah, you need to reverse engineer the first step,
Mm-hmm.
which sounds quite counterintuitive, but it's the truth. As you say, you might have, and I'm just plucking a number here, you might have $50,000, $100,000 as a deposit, but you have the serviceability. In other words, the bank will lend you $2 million.
Mm-hmm.
It really doesn't mean much. The starting point is the capital,
That's right.
and closely followed by the serviceability, because
Mm.
you need both at the end of the day. You also made another really good point about cash flow is in the eye of the beholder,
Mm-hmm.
so to speak, and that each and every property has different things that it brings to the table or to the portfolio, and that we need a balanced approach. Now, whilst we've talked about that you don't have to spend $1 million for it to be a wise investment decision, and what I mean by that, higher rates of growth, we don't buy into that. But I also don't buy into that we need to go to a one-trick pony town where there is elevated risk so that we can enjoy
The higher
the
cash
higher
flow.
cash flow
Yeah.
as well, because there is a risk associated with that. Mining towns as an
Mhm.
example, or one economy drivers and the like. So it is finding that balance, not just between cash flow, but what lets you sleep at night,
That's right.
which is one of the fundamental governors.
I think
of
that's
everything.
that's the biggest litmus test, right? And if the property that you've bought allows you to sleep at night, then perhaps it is the right property if you've ticked out all the fundamentals in that investment, right? But before all of that as well, Steve, I think one of the things that we need to be mindful of is what's our relationship with money to begin with, right? Are we chasing that quick win? We've always been chasing that quick win and have this last throw of dice to get that huge win.
Race get out
race
stakes.
yeah, that's
Race
right.
8 get out stakes.
Yeah. Or are we so petrified of losing the money that we are forever caught in analysis and we never make a move?
We're
right?
paralysed.
Yeah. So we need to actually sort that out and think of how your relationship with money is. And a really good example of it is if you go back to 2016-17, when money was flowing really well in the economy, everyone was buoyant, the prices were just skyrocketing up in Sydney and Melbourne. Everyone was increasing their discretionary spending by the spades. Right, so I went and upgraded my home theater system back then, and I got to talking to the guy because that's what we do. Is we talk to people to find, how we can create the rapport to then go through the negotiation phase. So
there was an angle there.
There
You
was an
just, you
angle
were just
there.
looking
Yeah,
for the
yeah,
negotiation.
yeah, that's right. Yeah. So and I was talking to this guy, and he said, I said, oh, you're probably struggling to move this higher priced item. He said, no, I've run off my feet because. And I just put two and two together in the sense that property market was buoyant. Everyone felt rich. And so therefore they splurged, right? Now, when you come back to a market like this, or any crises like this where it was, so last year it was the elections as an example, or the virus now, especially when the government's handed out the $750 as an example, yet they're struggling to get people to spend it because people aren't feeling wealthy in that sense, right? So the state of your mind, state of your wallet dictates the state of your mind is true in all forms, right? And it does also impact the types of property you buy depending on how much cash you've got, how much cash flow that's happening at that moment. And so you do end up perhaps splurging out on a property that might not be the right long-term property because you haven't taken into account your long-term income projections as well. You're just looking at your 2017 scenario as opposed to your 2020 scenario, right? So that's something that does dictate where and how rapidly people invest. And a true testimony to that also is a lot of these seminars and a lot of these workshops start springing up when the market itself is buoyant. Where are these seminars? Where are these courses and all that when the market isn't quite buoyant? They sort of die away.
Yeah. It, as you were saying that, and I know we've said it in other podcasts about the get rich quick overnight things, and usually the advertising around that is they're standing in front of their red Ferrari, their yacht,
Of course.
or their helicopter. Steer clear is our word of warning. Not that everybody who has a Ferrari, a helicopter, and a boat is a bad person. just to be clear, I mean, Vic, you've got 3 helicopters.
The toy ones.
Yeah, Lego sets, which you're still struggling to put together from the age of 8. But I think before we even start, as an investor in any asset class, we need to know what the exit strategy is, or the exit. And the exit doesn't mean the retirement of debt, as an example, and living passively, if you will, but it's also taking into account, should a crisis present itself, what exit strategies do I have, and does the strategy that I have today allow me to pivot slightly so that I can keep control of the asset, because that gives me time in the market, which is where the wealth is. And so the bottom line is that you actually need cash flow or cash flow management. So whenever we talk about cash flow in this podcast, let's just relate to that as cash flow management. But we also need the growth, because the cash flow keeps us in the market, brackets pay the mortgage, and control the asset over a period of time for the heavy lifting of time to give us the growth, as long as we're in the right areas to begin with. So if you can't have one, or you shouldn't have one without the other.
That's right. It's an equation, and you need to balance out both ends of the equation to get to the result, right? So this is where a lot of people, they become too impatient to get to a result, and maybe they haven't seen a growth in the property. And the reality of it is that growth does not happen every single year.
It's not linear.
It's not linear at all, right? And growth happens in spurts, and as it grows up in value, it also can come down in value. And you need to factor all of those in. And this is where, if you don't have good cash flow management, chances are that your circumstances will change as values come down, because it basically impinges on the economy around you as well. So you'll then be forced to sell a property that's actually come down in value. And so not only have you lost momentum, you've also lost real money, because you had to sell because you couldn't afford to hold on to it. So by buying the wrong property, in other words, striving to get the highest possible price for brag rights, or for $1 million property, if it goes up in value by 10%, it's another $100,000. Using that argument, you lose a lot of money that way. But if you did it in a diversified way, in the sense that still have $1 million exposure, but have 2 $500,000 properties as an example, that would give you a greater ability to take and change directions in times like this. And if the cash flow becomes really tight, you'd probably offload one instead of both properties. And it is in times like this, your $500,000 property is more affordable in our example here than the $1 million property, because there are far more buyers in this pool.
So it's about liquidity.
That's right.
Within the market. And we're not suggesting that a $500,000 property is the only way to go. It's horses. It's horses for courses. And you're up to, at the beginning of the foundation of creating a portfolio, you're some way down. It's just the numbers we were talking about there as a pure example. And I think that people really should be thinking about cash flow management all the time. But how do we do that? So it's all good to say that, but how do we create the portfolio so that it is, let's call it self-sustaining, or it's within our parameters of our shortfall component that we're willing to contribute to support the portfolio. And I think we mentioned that maybe last podcast around what is the shortfall and how much you are willing to contribute from your savings to support the portfolio. And it's within that framework number that you should be looking to create the portfolio, because once you get outside of those parameters, that's when you're starting to push all the numbers and extremities of risk, and anything that can go wrong and will go wrong will then jeopardize your entire position.
It will. And I'm glad you mentioned numbers, right? Because this is where a lot of people, when they're starting to invest, they're not 100% on the numbers. So if you don't know how much money is coming in and how much money is going out, how can you budget to allocate money towards property investing? I'm not talking about capital. I'm talking about the actual day-to-day running of your portfolio, right? Because that does have a finite number. Plus then you need to add your risk mitigation on top of that in terms of your buffers. So if you're not knowing how much money you've got left over to begin with, you really shouldn't be starting to invest, because that way you will, regardless of whether the property is a good investment property or not, it'll be the wrong property for you because you haven't looked at its holding cost in its true form. And as soon as something goes wrong, whether it is the economy, whether it is in your personal life, whether it is your job, or whether it is a tenant that's absconded, you will find that the true hurt gets revealed.
And amplified.
Absolutely, it will be.
And for 1 minute, if you think that there's never going to be a crisis or that point in time where you need to make some very quick decisions, you're kidding yourself. You haven't lived long enough. There is, as we mentioned, and actually you touched on it earlier on, we have COVID now. We had the election last year. We had APRA. We had a Royal Commission. We have a GFC. There is always, every couple of years, some crisis, and I'm using that word deliberately because for some it may not be a crisis and for others it is, or it even might be an opportunity for others because they've got the fundamentals correct, which is all around cash flow management and the ability to be able to execute an opportunity because their home is in order, their house is in order. Yeah.
So I've got a question for you then, Steve. I've already got a portfolio and I've focused purely on heavy capital growth. What do I do now?
Well, that really depends on the cash flow position. Once again, I don't want to sound like a broken record, but the very first thing you should do is an A&L. Let's do an asset and liability. Let's have a look at the cash position and how much time does our buffers and those pieces of mitigation that we've put in place. And I'm also going to overlay that with I've just lost my job. Right. So how much have I got in place to be able to keep the mortgages paid and still live effectively before things change for me? But if I've got nothing in the tank, if I've got no money put aside, no buffers, no anything, well then I really need to start looking to offload one or two assets, whatever it may look like, so that I can live to fight another day. But my answer to that would be don't get yourself in that position to begin with.
Absolutely. So it comes back to constant planning, constant reviewing of the situation, of your position, and also making sure that someone can wake you up at 2 a.m. in the morning and ask you what's your portfolio numbers, and you need to be fairly spot on, right?
I didn't know where you were going with that. It's just like, we'll ring you at 2 o'clock in the morning and just check in.
Yeah.
No.
Okay, so if you give us your phone number, we'll call you at 2 a.m. and check.
Better still, I'll give Vic's phone number and you can check in at 2 o'clock in the morning.
I am a morning person.
Yeah.
But not a 2 a.m. person.
Yeah, I'm good to about 1 o'clock in the morning. Then I go to sleep, but Vic gets up at 2. So you've got a sweet spot there. So the stress of rotating cash flow versus the contentment of accrual. Now, what we mean by that is the stress of rotating cash flow is the ups and downs as opposed to just, let's call it a linear approach, because we've created a portfolio that is balanced. So let's get back to the subject, which is the balanced portfolio approach. And what exactly do we mean by a balanced portfolio?
Yeah, so it is as it implies, it is a balance between your capital growth and your cash flow component. Right? In other words, the amount of money required to hold on to that portfolio. Notice I'm saying portfolio, not property. Yeah, so it's holding onto that portfolio. So whether it is $200, $300, $500 a week to hold an entire portfolio, it depends on your personal budget, right? So the idea is that you need to be looking at all of the moving parts in here. So your major moving part here is your mortgages, right? Because that has a big bearing as to what your holding cost is likely to be. So if your mortgages are way above your standard for an investor of your level, perhaps you need to relook at it. And we're creatures of habit, right? So we because it's not hurting us, because it's not bothering us right now, we tend to leave things alone. So we don't go and review our mortgages often. I'm not necessarily talking about refinancing. I'm talking about actually having a look at the interest rates that you're paying and making sure that it is in line with everyone else. A really good example would be if you've gone from interest only into principal and interest, or often the loans also revert to their standard variable rate.
Big difference
Big difference, right? A standard variable rate with most banks has a 5 in front of it. Whereas you could review your rates and potentially fix that with a 2 in front of it. So that's a fairly significant reduction in your running cost. The other thing, of course, you're looking at is what's the performance of the property and what's the purpose of the property itself, right? So why have you bought this property? Is it to set aside, it's a set and forget, and you're going to come back to that in a decade, 2 decades to see how it's performed, and it's slowly paying the debt off? Or have you bought this to do something with, whether it is a subdivision, whether it's a development, whether it's a renovation, or even something as simple as adding another room to this? So it's something that you're doing something with. Or is it something that you've earmarked to say, you know what, I'm going to hold it for 5 years, see where my position is, and by selling this down, it might give me a larger deposit for my better principal place of residence, right? So it comes back to your plan as to what the overall overarching plan is, and what does this particular property with its micro strategy on it, what does that bring to the mix, and whether it is now time to then pull the trigger on that strategy, or because of the current climate, is it wiser to sit back and wait it out, and in the meantime perhaps go back into the accumulation phase or the debt consolidation phase to progressively move closer and closer to your end goal. And of course, all along, what we're doing is constantly reviewing our goal for relevance. Now, by goals, I mean what's the end outcome we are after in our portfolio.
Yeah, 100%. Because the two finite resources that we have in terms of our monies is our capital and our cash flow. They only go so far. So we need, in terms of capital, we need the ability via growth to be able to recycle that capital, i.e. deposits, closing costs and what have you, to then move or deploy into the next property at a given point in time, unless you're starting with a very big pot to begin with. And the other finite resource is the cash flow, which is our ability physically to be able to control the mortgages, and then from a lending perspective, how much money the banks are willing to give you. Because if you can't get the finance from the bank because of a lack of serviceability, therefore cash flow, well, then you're stuck. And so the way that you create your portfolio needs to be all-encompassing, so that there is a mix, as you mentioned before, of properties that might be more around cash flow. Growth is always there, but we might be able to manufacture the cash flow, as an example, and that the growth is there to get us to the end goal in terms of wealth. So there's a wealth management component to this, and then there's the cash flow component to it all. Because in terms of capital or growth or equity, there are really 3 types if we shortlist it. There's purchased equity, so how you buy the property. There's manufactured equity, what can you do to it to enhance
renovation,
it?
subdivisions, that sort.
And then there's organic equity, which is just organic growth. And sometimes if the position is right for that person, you could potentially do all of that at once by controlling the right type of asset in the right area. And then we can plug that, because let's assume that the cash flow with that particular opportunity isn't that good. Now, I want to just make a point about isn't that good. It's each to their own. So someone might think 3.5% is a cash cow, is a yield, and others might think that's just horrific. So once again, finding what your level is the important things. But if we need to plug the cash flow gap, well then the planning stage of the next property, or we might have done it the property before, is about, well, how can we manufacture or create the cash flow? That might be a commercial opportunity. It might be a dual income opportunity. Once again, they've both got to have growth characteristics so that we're balancing the book.
That's right. Yeah. So what you're saying, Steve, is that we can't look at the property in its isolation, right? Whilst we're looking at the opportunity that property presents in its isolation, we need to look at its impact on the entire portfolio and its impact on us being able to borrow further money down the track, or its impact on us getting closer to our end goal, whatever that goal is, right? So it's really important not to get caught up, swayed with the opportunity of a lifetime, because the opportunity of a lifetime could often be the wrong opportunity in your portfolio.
There is an opportunity of a lifetime every day.
Absolutely.
Somewhere. Yep. It's just that how do you identify it and how does it fit into your portfolio? So I like that. At the end of the day, every property that you have in a portfolio has an absolute reason for being there.
Don't buy for the sake of
do
buying.
not buy for the sake of it. If your goal is 4 properties, as an example, theoretically you could go out and find the 4 fundamentally correct areas and just buy those and sit back, and you'll be good in 20, 30 years' time. But what happens between now and that 20 or 30 years' time is actually where the oxygen, which gives you the chance to breathe and live, is where the gold is. Because if you don't have the cash flow to support the mortgages, you can have all the growth in the world, but you won't realize it. You'll become a statistic.
Yeah. So essentially, your ability to support the property buys you time, doesn't it?
That's what it's about.
Time does the magic. Yes, you help it along with, doing the renovations, doing the subdivisions, buying really well, but eventually the major heavy lifting is done by time. And one of the things that people get caught up with is how much equity they've got and how much the portfolio value is. I think for far and most, it is a fool's gold in the sense that you can't really spend the equity unless you sell or unless you leverage off it in terms of getting a loan from it, right? You can't go out and take a brick and say, give me a cup of coffee, right? Maybe that's one way of getting coffee, but
The amount of coffee you drink, it'd be like a full wall.
I know, right? But this is where people get sidetracked in terms of the rhetoric that's out there in terms of, I've got $1 million property, I've got a $20 million portfolio. It's all irrelevant. What's really relevant is understanding that the cash flow gives you the lifestyle. So once you've unencumbered the debt, the cash flow gives you the lifestyle. The equity position gives you the wealth. They're 2 very different things.
Always have been and always will be, because the cash flow management is like an expansion joint in a building.
Oh, I like that.
It gets better. Because without the expansion joint, when bad weather comes, the whole wall cracks and falls over. So think of your cash flow management as that shock absorber between the good and bad times. And without it, there's all sorts of trouble around the corner. Because once again, there is always trouble. You can't have long periods without economic downturns, whether that be from a personal perspective or a macro perspective via the world or the economy. So you need to account for it all the time. And unfortunately, investors of any asset class have very short memories.
Yes, they do.
Always have. So you think about this. Literally 4 months ago, the world was living quite large. Record runs on the stock market. No recessions in Australia for a gazillion years. Everything was just pretty rosy, and then it happens. We have
just a flick of a switch.
Literally.
Yeah.
And so everything has been turned upside down. And today, for some, it's an opportunity. And we did a podcast about this maybe 3, 4, 5 podcasts ago on why we think that for some it's a fantastic moment in time to continue or start their portfolios. And for others, it's just you should do nothing.
Yep.
You should batten down the hatchets.
Weather it out.
And consolidate, whether that be around the equity position or the cash flow, so that it buys you time.
Absolutely, and that's where a lot of people get caught up in. When you're buying time via your cash flow, don't get impatient. Just because you haven't acquired property for 2-3 years because you're not in a position to, don't get itchy feet. Don't go out and just buy something for the sake of buying. This is where you will then get caught up in the slick marketing. You'll get caught up in the opportunity of a lifetime. You'll get caught up in wanting to see action. Don't confuse action with results, because it's the results we are after. And when you're taking action, it needs to be deliberate action. And sometimes the best action to take is no action. So you're not buying any more properties. You're waiting it out, letting it consolidate, letting the cash flow settle down. Because initially, when you buy a property, whether it is in the higher bracket or in the affordable bracket, it's still the same. You have your initial flurry of repairs, initial flurry of expenditure as things settle down, and then it starts to steady out. And then you have your occasional bumps when your tenant leaves or there's maintenance. And usually the maintenance usually comes about 4, 5, 10 years in a row. So this year I'm having a huge run of hot water systems in my portfolio.
Yeah, me too. Maybe it's the same person.
Must be.
Yeah.
So, or if it's your Brisbane properties as an example, change in legislation where you got to upgrade all of your smoke alarms as an example, right? So that's a major expenditure. But in between, you'll have the lulls in terms of the expenditure. And it is during those times that you may want to plan far better, maybe squirrel the extra money away, or perhaps look at acquiring another property, still taking into account that there may be spikes in your expenditure along the way, and making sure that you've got the money set aside to do that. Otherwise, what will happen is that you will start hating your portfolio. You'll start resenting the properties and actually resenting the property managers calling you because it's expenditure after expenditure. Or as we get out of these lower interest rates, and for sure we'll get into higher interest rates, all we don't know is that when, but it is definitely, I can give you 110% guarantee that it will happen. You will find
you
that
heard it here first.
Yeah, you heard it here first, right? Yeah. You'll find that if you haven't planned accordingly for your cash flow, you will have had to sell down at a point where the market is absolutely starting to take off again, which is usually the case, right? So because after every crisis, there's a dip, or during a crisis, there's a dip, and then there's recovery. And a lot of people, when they've had bad cash flow management or had gone in with the wrong numbers in terms of their holding costs, as soon as it starts hitting rock bottom, they've had enough. They'll start selling. And the sophisticated or the informed investors will then move in and buy it and ride the wave up in terms of recovery to then get good growth. And then it plateaus out again. So, like we said in the beginning, it's not linear, right? It comes up and down, up and down. It finds a reason to go down, whether the reason is unplanned, like today, or planned, like APRA. Right, so those things will happen in your portfolio, and if you haven't factored in those, and you have bought the properties purely on the strength of, yes, it's going to have fantastic capital growth because it's got X, Y, and Z factors on it, and you've ignored the second ingredient of this pie, so to speak, you'll find that it just will not taste right for you because you've missed out the most key ingredient, right? So the two key ingredients are, of course, growth, and the other is cash flow management in that sense, right? So this is one of the reasons that people lose their portfolio, lose their homes, is purely on cash flow management. It's not loss of equity or gain of equity or loss of want of the property. It is inability to hold on because they've got into such a negative cash flow, whether it is just the property itself or everything in the periphery, because you can't just be treating the property portfolio in its isolation. You need to be looking at your entire money management as well, and what your money paradigms are, and how you're handling money, how you're handling debt. Are you wearing your debt as a badge of honor in that sense, or are you actually being pragmatic about it and saying, okay, yes, I've got a $10 million debt, but to hold that $10 million debt, it's only costing me $400 a week to hold onto this $10 million debt. And this $10 million debt is leveraging or helping me hold onto, say, $14 million of assets. So you drill it back to, oh, no, I don't owe $10 million. I actually need to come up with $400 a week. And that's a better perspective. That's a better way of looking at your portfolio, so that you don't get caught up in all of this rhetoric of property prices going up, property prices going down, property prices going sideways, jobs on the line. All you need to know is that to get to your end goal, you need to come up with $400 each week.
Yeah, and that's a pretty simple way. Great figures too, by the way, like $14 million or whatever it was. But I think you're right. I think most investors lack an overall strategy, and that strategy might have been pretty back of envelope or beer coaster at the pub, if you will, but they lack an overall strategy and think that, well, if I just buy an amount of properties, time will do its work and I'll be okay. But there's a lot between buying and actually reaching that goal. There's the ability, as we've just mentioned, to be able to pivot. So in a perfect world, your property should have options.
Mm.
Right? The options might be around liquidity, manufacturing of equity, manufacturing of cash flow, a zoning, not just reliant upon all the time or every property about just organic growth. But in between that, you also have the review.
Yep.
Because things change all the time, whether it be your own personal circumstances. So if you're budgeting for 40 years, you've probably just wasted a hell of a lot of time because you don't know what 4 or 5 years is going to be like, let alone 40. So once again, having the ability within the portfolio to tack or to pivot, to be liquid, is actually safety. It's mitigation. And because there will be the ups and the downs as we
absolutely. There will be. Yeah. And it's important you mentioned that budgets, right? So, doing 40-year budgets, doing 5-year budgets. The budget, whichever way you look at it, obviously you need to look at it in my own personal circumstances. I do major budgets at the beginning of the year, at the beginning of the financial year, but I then look at it on a weekly basis. I look at my money coming in, my money going out on a weekly basis. Now, that's because I'm very hands-on on my portfolio, and my portfolio is fairly diverse in that sense, right? So I need to know how much money is coming in and how much money is going out to be able to make sure that there is always ample cash flow projection in terms of what's going to be required in a month's time, 2 months' time. So I know when the vacancies are coming up. I know when, apart from the hot water systems, when the planned maintenances are coming up.
You've accounted for it. You've allocated for it.
Yes, I have. Yeah. So it's really important that you understand that you may have a overall budget, but then you have the micro budgets per property and micro budgets in terms of your monthly cash flow, so that this doesn't become all consuming and alters your lifestyle to the negative because you've honed down so much on the numbers, but in the wrong way. You need to allocate money towards it, but also still continue life as per normal as well.
So the question I would have, I'm going to put you into a situation here. So you're an investor and you have, 2 properties. Forget the value for a minute, but let's just talk about what the cash flow scenario is for it. And let's say both of them are giving you a 2.5% circa yield. Actually, we will put value. Let's say that we're worth 1.5 mil. But you've got 2 of them. 2.5% yield. And you are at only this point in time, you're just sneaking through in terms of not just a physical ability to be able to hold them, but also from a serviceability, so the bank's eyes on you well. How many positions of diversification do you have, or do you have the ability to be able to tack and pivot based on rates today of say 2.5% to 3% versus rates at 5%?
You don't have much. You don't have much room at all because.
And sorry to interrupt, but that's my whole point, because rates, as you said, you can 110% guarantee that rates will go up.
Yeah.
And if you're not even budgeting for that today, and you're budgeting for it too late, then you've just found yourself as one of those people.
That's right. Yes, you've got to find the cash flow and find the money before you need it, right?
Yeah.
And I guess what you're trying to highlight there is that you need to forward project a few years into the future as well as to what your worst case scenario is going to be, and reverse engineer to say, okay, this is what I've got. This is my best case scenario. Most people do it in reverse. They project for best case scenario, and they realize they've got the worst case scenario here, right? So it's important that if you're at a red line in terms of holding your properties right now with the current interest rates, take a strong, hard look at your portfolio. You need to do some level of diversification, even if it means after speaking with the accountant, you offload 1 or 2 of your properties so that you're not losing the whole lot.
Because there's a certain element of speculation when you just all in on one type of property, one type of asset class, if you will, without education. So within the absence of knowledge, we guess, and when we guess, we're speculating, and the mother of all evil is speculating when leveraging debt.
Correct.
There is nothing worse, and so don't just go into it with your eyes wide shut. Get the knowledge behind you first, or surround yourself with the right people so that you do have that knowledge and you can make educated decisions, because there are so many moving parts to this.
Absolutely. And one of the rhetorics that came up in one of the Facebook lives was, you should not invest via speculating. You should invest via calculating, right? So you're calculating what your exposure is, you're calculating what your cash flow is, and you're calculating where you want to end up in terms of the portfolio, so that you're then buying the right assets to begin with.
And you can't do that even if you have a few assets unless you're continually reviewing
That's right, yeah.
your position.
And that's one of the things we do with our clients is give a continual review of their portfolio. So depending on the rapidity that they're buying and the position of their portfolio, it could be on a quarterly basis, or it could be once a year as they start going towards consolidation, right? So it is something that we encourage our clients. And if you're an investor, definitely, if no one is setting eyes on your numbers other than you, then I think you're going to embellish a little bit, because none of us like being wrong. None of us like being in a position where our judgment call hasn't quite panned out the way we thought, right? So we need independent eyes on the portfolio to call a spade, but also it just like we do with our portfolio, right? You look at my portfolio numbers and I look at yours, because we pick up things that was right under our nose that we've just glossed over because we know, I'll get to that.
You become too familiar.
Yeah, that's right.
And there's no cash flow there is cash flow projections, but that's probably not the right way to say it. But there is so many moving parts, as I mentioned earlier on, to the portfolio when you've got potentially millions of dollars of debt. If you're not reviewing the situation as often as you can and as practical as you can, or having someone do it for you, then you've got this beast of a potential machine that's just ambling on with no direction.
No servicing.
And no servicing, no cash flow management, and potentially no asset at the end of the journey. All right, so let's get back to the basics now in terms of creating the balanced portfolio. What's the very first? We have talked about the first step, which is your personal circumstances around capital and cash flow, the two finite resources. We have now a goal that we've created at the end of it, and we have let's call it a measured timeline. So that might be some benchmarks along the way, such as the 1, 3, 5 year benchmark timeframes, if you will. And we have a couple of $100,000 or $100,000, whatever it may look like to you to start with. We have decent serviceability. It's now time to pull the trigger.
Yep. So I'm assuming we've already got finance approval.
And we have finance approval.
Yep. Okay. Yeah. So we'd be looking then, obviously, depending on which way you want to take, right? Whether you want to go into pure capital growth type properties, or you're going enhance your cash flow type properties, right? Because that comes back to determining it is determined by your actual goals and your actual present circumstances. So it could be that as I look at a hypothetical example, that you've got a child coming on later in the year, and you'd be down to one income. Perhaps the first property that you're buying might not be that heavy negative cash flow. It needs to be relatively neutral in cash flow. Pre-tax, yeah. And then whose name does it go under? The person that's going to bring in the income to begin with. What's the plan with this property? Once you've sorted that out and looking at the amount of capital we've got and the amount of pre-approval that we've got, and making sure that the pre-approval actually matches the capital available, because often people have a mismatch. The broker might get you as high an approval as possible without taking into account the deposit required. And when you go on to that and you realize, hang on, I haven't got enough money to actually buy this property. So matching that first will help you determine which state, what type of property, and how involved are you want to be. Is it going to be a set and forget? So relatively unoccupied area with a relatively newish property, or do you want to get your hands dirty because you've got time on your hands, or you've got the skill set to enhance the value, right? Because like you said earlier, there's ways of boosting up the capital position. One is obviously by buying really well, which we do. The other is, of course, pushing the value up by doing a cosmetic renovation. So let's say your skill set was that way inclined. It would make sense to start off with that, because that way we actually enhancing the value straight away. We potentially increasing the cash flow onto that property straight away as well. It also gives us the ability to then leverage off that quicker to get into the next acquisition, right? But as we're buying the first one, we need to be looking at the second property that we're potentially going to buy as well, so that we're not buying something that totally locks us out of being able to purchase any further properties at all, because that's our max tolerance limit in terms of capacity from the banks.
Yeah, and so once again, many moving
different
parts, and everybody's circumstances are a little different. So we're trying to be as general as we can here. But at the end of the day, really, it's about multiple streams of income.
Correct. You don't want all the eggs in the one basket. Like, so one of the fundamentals of any investing is you don't want all the eggs in one basket. Now, yes, property is the vehicle, that's one type of asset, but it's just like shares, right? So when you're buying shares, you're buying different types of shares as well. Same with property. You're buying different types of properties, different areas, and definitely a very long time ago, one of the books I read said, you don't want to be a big fish or a shark in a small pool. You want to be a shark in the ocean, right? So what I mean by that is you don't want to be a multiple property owner and owning, say, 20% of a suburb.
No.
Right? So I'm talking about obviously regional areas and so forth. Instead, you could come into a area that is got far more population and have the same exposure there. We'll have far greater diversification, far less risk, and far more people able to take the properties off you, buy the properties off you for a profit to you if you wanted to sell down.
Yeah, and so diversification.
Yep.
All the time. But to be fair, though, you might have a quadrillion properties, and so maybe 20 in one suburb is diversification compared to the other. But if we're going to be real, not many people will have that amount of property.
No.
So it is really looking at it in single digits in terms of the overall portfolio, just to keep it simple, and making sure that you are borderless, as we often talk about.
Yes.
And that just like a share portfolio, there are different reasons for different types of these properties being in the portfolio to give us the balanced approach. So I want to stress that again. There are properties there that are there for potentially cash flow. There are properties there that are there for potentially growth. But as long as we're continually balancing the bottom line of the overall cash flow position on the portfolio, then we're in a safer position than being all in on one asset class, one big debt, one stream of income.
That's right. So what you're saying, Steve, is that when you're buying properties, it might not have both components on it at the same time. But as you're looking at your entire portfolio, it's balancing out. So one may have a lot higher capital growth projection, but far lower yield. So, you're circa 2% as an example. But that could be offset by another property that has still got good growth, but has got a far higher yield and has got the ability to enhance the yield yet even further by perhaps putting a granny flat on it. So then when you look at that in combination, it reduces your holding costs significantly and therefore allows you to then go forward in terms of building your portfolio further, right? And importantly, one of the things you mentioned was borderless investing. The reason why we want to be borderless is that each state has got its different growth cycles and different types of properties and different fluctuations within the markets and the micro markets.
I'm glad you said that, because over 15,000 suburbs throughout Australia, and people want to give commentary around the market as though there is this one market. And it just doesn't work that way. You want to say there's a general market, then there's a state market, but the markets are actually randomly independent of each other.
That's right.
To some degree, and potentially the best properties that are going to, in 5 years' time, are the ones that are stagnant today. But there's all the right ingredients for it to grow in the very near and immediate future. So once again, the diversified approach is absolutely paramount for a degree of risk mitigation, but also being able to capitalise on opportunities because of that economic circumstance at that point in time, in combination with your own.
Yeah, and you mentioned growth and how it may not grow straight away. I wanted to bring an example from one of my very first properties I bought, which was a unit in Campbelltown in here in New South Wales, which was my first investment property that I bought back in 1999. Paid a princely sum of $70,000 for it, for a 2-bedroom unit. And all of my friends and all of my advisors at the time said, Campbelltown hasn't grown for 12 years. Why are you buying there? Now, I bought there because that was the only place I could afford, right? That was I didn't know much at the time, but everything worked out well, right? But if you looked at it from that 12 years of no growth, and pretty much immediately after I bought, just because I bought, of course, it had a growth surge, absolute growth surge, and the price rocketed from 70,000 to 185,000 within 2 years of that time, right? And then it stagnated again, right? So if someone's buying in there and you're looking at the previous history of growth, and it works both ways, whether it has a really huge growth and you're jumping in there and buying, or whether it has a no growth, you need to be looking at what the fundamentals are, and then what are the catalysts coming in to help surge the growth. Now, the catalyst is not just infrastructure and employment, it's also the economy itself, the market sentiment itself. You need to look at all of those things. So don't get stuck in terms of, this area has had no growth for the last 10 years and therefore it won't grow. And also, equally importantly, this place has had phenomenal growth for the last 10 years, so therefore I need to buy in here.
Yeah, there's both sides to the equation there, and I'm glad you mentioned that it was your first property and that you didn't really know much. And probably, 5 podcasts ago, you should go back and listen to it, where we talk about the mistakes that we did early on in our investing piece. And we're quite open about that, and some of those mistakes we still own today individually, and but also the wins. And I think it's important that people know the things that we've tried and that didn't work because we didn't have the education around us back then, because no one existed like they do in today's capacity. And the other point I want to make about what you talked about was really around data, because if you were reliant upon that piece of data where there was no growth for the last 10 years, let's pretend that you fast forward and that you're who you are today, you wouldn't purchase there because the data told you there's been
That's right. You told me not to buy there.
So my point is, if you are reliant and you think that data is the holy grail and the be-all and end-all in your investment decisions, you need to think again.
Ground truth is what gets you there.
Yeah, data points you in a direction. The ground truth will reveal the gold or the decision behind it. If you are relying upon algorithms within data for real estate, you're walking a very fine line, and you will be burnt somewhere if you just rely upon that. So the truth, the data behind the truth, is just as important as the truth behind the data. Now, we're quickly running out of time, Vic. So what would be your takeaway from this?
Really, it is all about doing your household budget and bringing it back to your disposable income and not fudging the figures to begin with, right? So that's paramount, and understanding what makes a good portfolio. The first is cash flow. The second is the availability of capital. The third is availability of finance. So you could have all the cash flow that you've got and all the capital that you've got, but if you can't get a loan, then you're going to be buying cash, so you'll need a lot more capital, right? And then once you've got those three, you need to be buying towards a plan. What's the purpose of this property? What am I going to do with this property? So that way you can shut out the white noise. And once you've done that, then you pull the trigger to say, okay, this is where I'm going to buy, match it to the finance. And once you've bought it, make sure you actually manage it. Because most people end their journey once they bought it and they say, okay, yeah, it'll grow. You need to look at the numbers on a consistent basis to ensure that you're managing it. What we call in terms of fine tuning your portfolio. And once you've done all of that, then you look at, okay, what next? But most people try and put too many purchases too rapidly without looking at the fundamentals and looking at where they're going, especially in a climate like this. This is where they would go wrong because they haven't done their numbers.
Yeah, and I'll add to that, Sam, but that before we start, we need to think about the exit.
Yep.
And we need to reverse engineer from then. And as I mentioned earlier on, we need some tangible benchmarks along the way. So once again, we talk about Design a Decade. I think that was the last podcast where there's the 1, 3, 5 year immediate goals with a 10-year overarching and then beyond. But they're tangible. We can reach them so that it's not in the never, but we need to be very structured, deliberate, methodical in terms of the creation of the portfolio and each asset type within there and the reason that it needs to be there and the result that it gives us, so that once again we're building a very balanced portfolio, if you will, that gives us longevity.
That's right, and it's important to put a time frame to it, right? Because if you don't put a time frame to it, there's no time pressure on it. So it's like if you got homework as an example, right? Remember during the school days, if you had homework and it was due in 2 weeks' time, when did you start it? Probably the night before.
Yeah, no, I was actually trying to. If my kids are listening to this, I was 2 weeks. I'd start.
Yeah, of course. Me too.
If not, I was the crammer.
Yeah,
from way back.
And that's what most people do with their property investing is then because they haven't put a time frame to it. Come age 55, then all of a sudden they wake up, geez, I've got to do something, right? Because exams coming, right? And
which
so
is the retirement is end and I don't have enough,
right.
I don't have enough.
That's right, yeah. So that's why you need to start as early as possible and put a time frame to it. Where does it end? The exit, where are you exiting out of it? And if you've got the time frame, then there is a bit of pressure to get it right and have a sequence of purchases, whether it is one purchase or multiple purchases. And that's the main secret of successful property investing. It's not a buy whenever you remember. It is a planned, methodical approach.
And so it should be when there's millions of dollars
Absolutely
on the table, almost like clueless enthusiasm. Really, it's
I like
like
that.
we know we kind of should, and it sounds pretty attractive to doing it, but there is a lot of hard work creating a portfolio. It's not just, as you mentioned, ambling along and, well, I think I better buy again because it's been a while.
Yeah.
I've actually found the most successful investors are the ones that are methodical and structured and that are operating within frameworks so that they can reach these tangible milestones along the way, because it's really easy to fall out of the habit.
Yeah,
and just say,
life takes over.
Yeah, and I've got to get another loan approval, and they want a meter high full of paperwork, and it's just all hard. I'll put that on the back burner, and then what usually happens is the market, as an example, starts to take off. It's a mad scramble with everybody else to do the very same thing, and you find yourself actually paying 5, 10, 15% more because now there's a FOMO effect within the market. So the best investors are the ones that are structured, methodical, and deliberate. And that actually put the hard work in to be in a position to purchase and potentially surround yourself with people. I know I do. I mean, you hold me responsible on my portfolio and I hold you responsible for your portfolio, making sure that we're hitting our milestones along the way. And I would suggest that others have those people in their life as well.
So I guess I'll use that segue, Steve, and I'll ask the listeners that if they wanted us to hold them accountable and take them through the journey in terms of building a sustainable portfolio that doesn't negatively impact lifestyle, then give us a yell. We're more than happy to chat. The email address is questions@rightpropertygroup.com.au, or if you're more of a phone person, 1300 302 166.
I was just about. I would not know that number.
I know it.
I know
numbers.
I don't remember the last time that we've ever given that number out, but obviously people use it on a multiple times a day. Well, there it is, guys and girls. This fortnight's version of the filmed Investing Insights podcast. We have another one coming out in another fortnight, but it'll be with Phil Tarrant from SPI, and in between that we have our Facebook Lives and our other social events. So feel free to jump onto our social pages, Insta, Facebook, LinkedIn, whatever it may be, and interact, ask the questions, and we will see you in 2 weeks' time.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.